So basically, we are doing when one sole trading concern is meeting with another sole trading concern and we are forming a partnership. Are you with me?
Yeah.
Okay. So the first step in this is that we had found out the net assets taken over, that is the NATO. Are you with me?
Yeah.
Okay. And
Yes.
this NATO becomes the capital account balances of the new partners without goodwill adjustment. Are you with me?
Yeah.
Okay. So that means we made a statement of financial position where we took the net asset, non-current assets at the revised value. Then we took the current assets at the
Hmm.
revised value.
Yes.
Okay. Then we took the trade receivables at the revised value. We took the cash and cash
Yeah.
equivalent at the revised value. From that, we subtracted the trade payables and we got the NATO, which becomes the capital account balances of the new partner.
Hmm. Yes.
This is without the goodwill adjustment. Are you with me?
Yeah. Yeah.
Okay. But now there are chances that A and B would feel that the value of their business is much more than what they are bringing in.
Hmm. Okay.
Suganya is feeling that the value of a business is not 78,000. It is much more than what she is bringing in, and she thinks that it is 60,000 worth more. Please read this.
Okay.
Suganya feels that the value of her business is more 60,000 because of the goodwill that is attached to it. And Ibrahim is feeling that it is worth 40,000 more than the goodwill that is attached to it. Are you with me?
Yeah.
And they have
Yes.
asked us
Yes.
to make the capital account. Why will they ask us to make the capital account?
Um. Because you have to raise the goodwill, right?
They ask us to make the capital account so that we can find the revised value of capital. Why do they ask us to make the capital account? Why do they ask us to make the capital account?
Because you need the revised value of the
So we
capital.
need the revised value of capital. How do we get the revised value? The net
You
assets
have
taken
to
over, in that we will add what?
you'll add the goodwill raised and
And you will
you
minus
will
the goodwill.
goodwill written off
So when you are making the capital account balances, I'm sure you're on which page number of the book?
of the book.
Page
Uh,
number 235.
235. Yes.
For making the partner's capital account, when you're making the partner's capital account, the first thing that you will write the balance begin down. This is the value of their NATO without the goodwill adjustment. What is this? Value of their
Back
NATO without goodwill adjustment. So it is
value.
1,000 and 45,000. Please write it.
Okay.
After that, what happens is Suganya feels that the value of the goodwill is 60,000. That means she feels her capital is more than what 78,000 that is mentioned over here. And Ibrahim feels his capital is more than 45,000 that is agreed over here. So we raise the goodwill. So this is called goodwill raised. So understand one thing, that goodwill is raised in the original value.
Yeah.
In the original value of what it was. Okay. After this, it is a normal policy because there is no monetary transaction involved. You have not purchased the goodwill. It is the goodwill that has come along with running the business. I'm introducing a new concept over here. You have not purchased the goodwill. It is the goodwill that has come because you are running the business. So this is called inherited goodwill. What is it called?
Inherited goodwill.
And inherited goodwill is never shown in the books of accounts. Inherited goodwill
Yeah.
is never shown in books of accounts. That means you always have to write it off. What do you have to do?
Write it off.
You have to write it off. And how do you write it off? You write it off in the new ratio, or in the ratio in which the partners agree to share profits. Okay, so two things you need to put over here. Goodwill will always be raised in original value. Can you please repeat it for me?
Yeah. Goodwill will always be raised on the
In the
original
original value, and it will be written off in the ratio in which they agree to share profits. So goodwill will be raised in the,
Original value.
and it will be written off in the,
The share agree to share profit ratio.
ratio in which they agree to share the profits. So can you tell me in which ratio have they agreed to share the future profits? See the question over there.
So it's equal.
In which ratio they have agreed to share the profits? So they have agreed to share the profits equally. That means you're going to write off goodwill how?
Equally.
Equally. What is the amount of total goodwill that is raised? It is 100,000. So you will write off goodwill on the debit side. This is the goodwill written off. Please do it along with me. 50,000 and 50,000. After writing off goodwill, what will happen?
Now you will get the revised value. Now you'll balance.
Now you will get the revised value of this.
So must you just write balance CD, right?
It will be the balance CD. So can you find out the balance CD?
Yep.
What is it? This is
So for
95,000,
so
and this is
yeah,
how
and 138,000.
First, give me
So
the
first,
total
so when
value that is down.
Miss
No,
138, not
this is 85,
Miss
right?
1.
What is this total?
Yeah, but the other one is 138.
138,000. Please do it along.
Yeah.
138.
So it becomes 88.
138,000 minus 50,000, it will become how much?
88,000.
And the other one, 85,000 minus
40,
50,000. How
45.
much? 45. What does this become?
The revised capital
Revised
balance.
capital value after what?
After
Adjustment.
goodwill,
After goodwill adjustments.
goodwill.
So tell me the
Yeah.
steps of merger of one company with another company.
Okay, so first you'll prepare. You want to find out the NATO, which is the net
Net
asset.
taken over.
Yeah, taken over. So you'll do your NCA plus CA minus your current
NCA
liabilities and
plus
your
CA
non-current.
minus the current liabilities. What is this
Yeah, which will
called?
what?
What is this NATO actually? Capital account balances without goodwill
Without
adjustment.
the adjustment of goodwill.
Then what will you do?
Then you will add your goodwill raised
And the goodwill
on
will be
the
raised in which value?
the value
Original
given.
value. You will
The
add the
original,
goodwill
yeah.
raise, and goodwill will be raised in the original value. Then you will deduct
Yeah.
what?
The goodwill
Written
of at the share of profit ratio given in the
And
sum.
the new profit sharing ratio. After you get the new balances of the capital, what will you do is you will prepare the revised statement of financial position. Okay.
Okay.
What will you prepare? Revised statement of
Divide.
financial position. Before you go at the revised statement of financial position, I want you to know the journal entries of creating goodwill and writing of goodwill. Can you give me the journal entry of creating goodwill?
Okay, so creating goodwill would be goodwill
Right.
raised, I think.
So goodwill is a
Oh,
non-current asset, and a
debit.
non-current asset is getting increased. When you're
Yeah.
raising the
So
goodwill, a non-current asset is increasing. Goodwill is always raised in the goodwill is always raised in the original form.
original.
So it would be S capital account credit and I capital account credit. Are you with
Yeah.
me? This is
Yes.
the first entry of raising the goodwill. Then your writing of the goodwill. What will be the journal entry to write off goodwill? Capital debit,
Capital account
goodwill credit.
goodwill credit. It's decreasing.
How much? It will always be written off in the new profit sharing ratio or the profit sharing ratio that they agree to distribute. There were other two things that I explained you about goodwill. What is the two things about goodwill? There are two types of goodwill. No, there are two types of goodwill. One is the goodwill that you purchased, and one is the goodwill that is inherited. When you purchase any goodwill, this you can show in the books of accounts because you have paid money. Hello. Yeah. So we studied two things about goodwill. What are the two things that we studied about goodwill?
Goodwill raised is on the original value and goodwill written off is in the
And another
ratio.
thing, there are two types of goodwill. What are the two types of goodwill?
Two types.
Yeah, two types of goodwill.
Raised
One
and
is
written
the
off.
inherited goodwill and other is what?
Oh.
One is the
Inherit.
inherited goodwill and one is the purchase goodwill.
Yeah, okay.
Purchase goodwill is always shown in the books of account because there is monetary value involved.
Okay,
Yeah.
all right.
Inherited goodwill has to always be raised and written off. It has to be raised and written off. This is never shown in the books of accounts. Are you
Okay.
with me? So now what
Yeah.
you have to do after you do the goodwill adjustment, you get the revised capital account balances. After you do the adjustment, you get the revised capital account balances.
Yeah.
Yeah. You've got the revised capital account balances as 88 and 35.
Yeah.
Now prepare a new statement of financial position. The question has given you this requirement. Prepare a new statement of financial position after giving adjustments to goodwill. That means the non-current assets would remain the same, current assets would remain the same. The capital would now be different. The capital of Suganya will be 88,000 and Ibrahim would be 35,000. And then the current liabilities. Prepare.
Okay.
Prepare a new statement of financial position after giving adjustments to goodwill. Except the capital account balances.